Each week for several months now, inventory levels of unsold homes on the market has been expanding compared to last year. Even as inventory declined this week, it is relatively growing compared to a year ago. This week, inventory fell by 0.5%. A year ago, it fell by 3% in the same week. New listings each week, which were record few last year, are growing now too. There are still notably not a lot of sellers, but home sellers are gradually easing back into this market. People are sharing local anecdotes with me about seeing more sellers in their neighborhood finally as well. Inventory this spring looks to be much better for prospective home buyers than in any recent year. And anytime inventory rises, you start to see housing crash hyperbole on social media. And it is important to keep watch on the demand side of the equation as well. We can see that home buyer demand is also ticking up by most measures. And there's a lot to dive into here. And so we'll see if we notice any signs of housing demand and supply getting out of balance. And we'll tackle some of that today. Also, this Thursday, February 15th at 10 a.m. Pacific, is our monthly webinar. This is where we get to spend an hour with all the data, and we can do deep dive into both the supply and the demand side of the equation. I'll share some new leading indicators of future listing inventory. We'll also look at the impact of mortgage rates and what happens if rates fall or jump from here. And we'll spend time with the local markets too. If you need to communicate about this crazy market with home buyers and sellers, you should join us. There is a link to in the description below to register. Click that to register to save your spot. These webinars are limited to 1,000 attendees, and we always get way more than that who want to join us. So you can reserve your spot now. Click the link in the description below to do that. And we'll see you Thursday, February 15th at 10 a.m. At Altos Research, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data so that you can understand it immediately as it happens. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at the details of the U.S. real estate market after the first week of February 2024. So I want to start today with the new listings volume, which is notably finally climbing over last year's anemic levels. So there were 66,000 new listings this week, of which 14,000 are already in contract. So that's 14% more new listings this year than the same week a year ago. 14% more. Sellers are finally coming back to the market. 14,000 of those new listings are already in contract. That leaves 52,000 new listings unsold to add to inventory. That's the most since 2020, before the pandemic. In 2021, there were actually more total sellers, but at the peak of the frenzy, so many of those were immediate sales that they never really got counted as active inventory. So the net result is that we can see sellers who sat on the sidelines a year ago are starting to ease back in now. This is the new listings volume chart. Each line here is a year. The gray lines are past years. The dark red line at the left end of the chart is the start of 2024. And we've been talking about for weeks about growing inventory. And you can see here this week, 14% more new listings than last year at this time. And see how the dark red line is starting to trend higher than the light red line of last year? That's what we're looking at. Each week, more sellers than a year ago. This chart is also useful in that it shows us that we still don't have a lot of sellers. It shows us recovery, not panic. There are 25 or 30% fewer sellers each week now than there used to be, but it is climbing. And so see the lighter gray lines here are years past. 65 or 70,000 new listings used to be common in February. So this is an indication maybe that the real estate market's deep freeze of 2023 is finally thawing. So the takeaway here is we can see new sellers more than last year. It's not a ton of sellers, but it is growing. So if sellers are growing, we need to know whether buyers are growing too. We wouldn't want supply to add and demand to get out of balance. So What we want to watch when new listings build, a key factor I like to track is the immediate sales. These are the listings that hit the market. They take offers within hours or a few days and then go immediately into contract. They essentially bypass the active market. These immediate sales were the defining characteristic of the pandemic real estate boom. They included the bidding wars and multiple offers. There are still immediate sales which happen in every market, but we want to know how many because it tells us about housing demand. So in this chart, we're looking at the new listings volume each week and how many were immediate sales. So each bar is a week. The taller the bar, the more sellers. The light portion of the bar are the immediate sales. So of the 66,000 new listings this week, 14,000 are already in contract. That's 6% more immediate sales than last year at this time. So immediate sales are growing just a bit. So the dotted line here helps you see that we have nice growth in seller volume versus last year. A big jump really this week, 18% more sellers this week than last week. In 2022, 2 years ago, there was still a lot of people trying to get the deal done in February before mortgage rates went up. So for this roughly the same 66,000 new sellers in February 2022, 21,000 of those went into contract immediately. So it's only 14,000 this week. But last year it was even fewer. So, each week we can see more sellers testing the market, more buyers are finding their opportunities as well. And this is obviously, there's no boom in the market like there was at the end of the pandemic 2 years ago. But therefore, inventory is building a little longer. So see how much taller this bar is this week than last year at this time. More sellers, more immediate sales. And because supply was so tight last year, there was probably more upward pressure on home prices at the time than there is now. That's an interesting leading indicator to pay attention to. Okay, so we see more sellers entering the market, but that doesn't mean inventory is jumping. In fact, there are now 495,000 single-family homes on the market this week. That's 0.5% fewer than last week. So we have more buyers and sellers this time of year, so the active inventory of unsold homes ticked down. The difference is that inventory ticked down 0.5% this week. A year ago, inventory fell by 3% in the same week. And so this is what I mean by when I say that home prices had more upward pressure a year ago. Inventory declined this week, but is now 12% more than last year at this time. And while it is totally expected that we have more buyers and sellers in February, fewer homes on the market each week, that 0.5% decline is actually pretty narrow. This implies that inventory will start growing week over week pretty soon. The spring buying season will have improved selection for home buyers. Inventory will continue to build. When we look at the chart here with each year's curve, you can see that inventory is ticking down now, a bit like you'd expect in February, flat or down typically. In the pre-pandemic years, inventory would have typically bottomed already earlier in late January or early February. So last year's relatively strong demand compared to very few sellers meant that the bright red line dipped a lot in the first week of February. At the time, a year ago, I was pointing out that home buyers would start pushing prices higher, and a lot of people didn't believe the data at that time. This year, the price pressure is not as strong because we have more supply. So this is a good signal, though, for total transaction volume in 2024, but is not as bullish for home price appreciation. Number of sales will keep climbing, prices not as much. So with more inventory and more sellers comes the opportunity for more sales to happen. This week saw 61,000 new single-family home transactions started. That's 9% more than a week ago and 3% more than a year ago. Last year was so restricted with so few sellers that sales were ultra low, and that is starting to change, or at least it's trying to change. 7% mortgage rates are not helping home sales volumes. And as I said, this week saw 3% more home sales transactions than the same week a year ago, 3% more. The last few weeks did not really show any growth over the previous year, and that's kind of discouraging because last year was so low. But this week, sales ticked up again, and maybe people are coming out of the deep freeze, the literal deep freeze. Unfortunately, mortgage rates also ticked up this week, and that held some buyers back for sure. So the sales rate growth is definitely weaker than the data was looking like a month ago when rates were lower. In this chart, each line is a year, and you can see at the left end of the dark red line is trying to break over last year. I imagine that if rates fall into the lower sixes in the next few months, you'll see that dark red line start to approach the sales pace of 2022 by mid-year. If rates stay at 7% or higher, our yearly gains will probably evaporate and we'll be in for another super weak year of home sales. You can still see a lot of headlines that say home sales are coming in record low, and this is what they're referring to. Basically, the bearish interpretation shows that this trend is that home sales are not really growing yet, basically about the same levels as last year, and the last few weeks actually looked really bearish in that sense because mortgage rates have been rising now for 6 weeks. And you can see that slows would-be home buyers very quickly. So fingers crossed, the American home buyer gets a lucky break in the next few weeks and months. The median price of single-family homes is $425,000 again this week. The price of the new listings is also unchanged at just under $400,000. What we're showing here is 6 years of home price appreciation. Home prices are a little more expensive than last year at this time, a couple percent. Up until recently, I've been expecting mostly positive pressure on home prices all year long, but we got hit by extra strong job news, which pushed the bond market higher, and therefore mortgage rates jump back to 7%. And if that trend continues, that's going to keep home buyers at bay, and each buyer who doesn't make an offer means slightly more downward pressure on home prices. So I don't predict mortgage rates. Had you asked me a month ago, I would have said it was unlikely that we'd be back at 7% now. It seemed at the time like rates were heading down. As I say, though, I've been wrong about the direction of mortgage rates for 30 years. Why should I start being correct now? I don't know where mortgage rates are heading. But it's kind of funny because then, even though I don't know that, it seems like the prevailing wisdom is that rates are headed lower this year, and therefore my commentary is probably skewed toward that expectation. But we can see that rates defy expectations all the time. So what happens if rates rise? We'll spend more time in that scenario on the webinar Thursday. So click the link in the description below to save your spot. That's Thursday, February 15th at 10 a.m. Pacific. Join us for that. And it can be hard to communicate all this with buyers and sellers. There are a lot of folks on the sidelines waiting for rates to drop so they can swoop in for their perceived sudden bargains. They may not realize how much competition is waiting right along with them. And meanwhile, mortgage rates are actually rising. If you need to help buyers and sellers see the actual data, you should join us at Altos. Go to altosresearch.com and book a free consult with our team. We'll help you know how to talk about the market and the data with your clients and prospects today. There's a link in the description below to join us. Click that and let's get started.